Well, good morning. It's terrific to see you all out here taking charge of your financial futures. You will all know Buffett's famous aphorism that one, to get ahead on Wall Street, must be fearful when others are greedy and greedy when others are fearful. You'll all know that. There is no better time to remind yourself of that quote than now. And I'd ask you to think about why the canny old fox who said that might be sitting on $120 billion of cash today, fully a quarter of the market valuation of Berkshire Hathaway. Why might that be the case? What's apparent in markets at the moment is a pairing of immense greed with a fair sprinkling of fear. I would ask you, please, for your financial futures, to consider avoiding the greed and consider leaning into some of the fear. I think in coming years that will prove very, very rewarding. So there really is a bubble. You know, if I was to ask you when the last great financial bubble occurred, you might think of, tech stocks in 2000 or Japan in 89 or the great bubble of 29. You're in one. You're right in the midst of one, and it's a ripper. Bubbles tend not to end well. I make no predictions, but the history is clear. But tied to that bubble, interestingly, is this absolute terror that investors have of anything cyclical. So anything with any variability or perceived risk. The ultimate risk is price. The ultimate risk is price. So when people are worried about cyclicality, and I'll discuss the kind of opportunities I mean, that's exactly the kind of thing you might want to discover as an investor, to lean into. Because there are lots of assets out there that are very, very cheap. And I'll just give you this little factoid. The average market valuation out there in equities is not that high. The average of all the markets we look at closely is about 14, maybe 14 and a half times. So maybe one PE turn higher than normal over the last 120 years. But that includes this immense overvaluation. So if we're about average for everything that's very, very expensive, there must be something definitionally that's very, very cheap. There has to be, for that to be the average. And that's really exciting. So where are we? This squiggly line it's just a ratio. There's nothing clever or predictive about it. It's the ratio of firms on the S&P 500 who are classified as growth, so fast growers, generally a bit higher priced, versus firms that are value. It goes back to 94, which is as long as the series goes back. I just want to make a quick point. The trough in the middle was one of the great bubbles of all time. We are there. We have taken out the levels of 99-2000 in terms of the ratio of value stocks to growth stocks globally. This is in the US specifically, but it's truly global. Same thing applies in Europe. Same thing applies here in spades. This is a genuine bubble in terms of valuation, sentiment, positioning. It's real and it's apparent. And it shouldn't surprise you because we've had immense distortion of prices. You've had this long monetary experiment for over a decade now, and it has resulted in enormous excess. You must not think that unprecedented monetary policy hasn't resulted in anything. It has. It's resulted in incredible excess, and it's very, very dangerous. But you might think, but these firms are all better now. Back in the tech boom, it was pets.com. It was crazy businesses that made no sense. That is just not true. This squiggly line is the ratio of firms that are profitable to unprofitable in the software business, which is the real core of what I'm talking about, this bubble that I'm talking about. Again, we've taken out the lows of 99, 2000. More of that industry than ever before is unprofitable now than ever. If that doesn't alarm you, I don't think you're awake. This is really, really dangerous stuff. And there's just so many indicia of this. This is just one. I mean, for example, over 80% of firms IPOing in the States have no profit. 80%. That, again, is higher than in 99, 2000, in that mania of back then. This is a genuine bubble. So a little reminder of how these things can unwind. This squiggly line is the NASDAQ composite. This is an index of stocks on the NASDAQ. The little blip, the little foothill in the middle of that is the 2000 boom. I just want to remind you all of how that played out. Over 3 years, that market fell by 75%, and it didn't make a new high for 15 years. I make no prediction about the future, but you do want to understand the past. So how did we get here? Low interest rates are part of it, but there's a narrative that's at the core. You know, why do we all care what Elon Musk's pretensions are for his rocket business? He has no scientific qualification at all, but we're all obsessed with this sort of narrative of disruptors and you know, the wonders of new technology. If you get carried away with that kind of thing, as you might have with radio stocks or car stocks in 1925, you tend to do very badly. That's where the greed is. That's where the mania is. And it's leaving behind whole segments of the global economy and of stocks you can own that are very, very attractive. So back to that point about cheap capital. This squiggly line is US corporate debt to GDP. And those lumps, this sort of malformed dromedary there, those peaks and then retrocessions, they correspond with booms and busts. So the first kind of peak and trough that's most evident is 89 into the early 90s. The next is 2000, with the retrocession after that. The next is 07, 08, which will all be familiar to you. And again, we have reached a new high. We've reached a new peak. Again, I make no prediction about the future, but please understand the history. When we have got to this level of corporate debt to GDP, we usually have a pretty awful time thereafter. It's the history of the last 4 recessions in this place. There is real excess in the system. Now, relating that back to the tech mania, when one wants to tell me about the wonderful disruptor and the brilliant business model that they have and the land grab, which means that they needn't worry about making a profit, they can exist in some profit-free wonderland forever, that is just the combination of free capital and a nice story. And again, that's a really heady witch's brew for your wealth. Now, these bars are the total dollar number of corporate bonds outstanding. It goes back to 1980. The point I want to make about that is that in the last 10 years, we've roughly doubled the number of corporate bonds outstanding. And the thing that I can't capture there is the awful quality of those bonds. So back 10 years ago, when we had half as many of them in the States, a third of them were triple B. So the lowest ranking of investment grade, that is now 53% of triple B. So half the market is triple B. And of that half, on just a straight gearing measure, half of the half should be junk. So 2.5, and that means 2.5 times the size of the junk market is sitting ponderously just above junk. So please think through what might happen to the wonders of free capital plus a narrative if you get a slowdown. And you might say, what, interest rates will go down. That's wonderful. That's not what happens in a recession. Interest rates were 0 in 2009. Could you borrow any money? The answer is no. The capital dries up, and the cost of capital to borrowers goes through the roof because spreads blow out. Risk aversion gets very high, and your cost of borrowing, if you can get it, goes through the roof. So the wonders of firms like Netflix and Tesla, who are among the largest issuers of high-yield debt in the world, in a recession, look awful, is my contention to you. This is where the feast is. This is where the greed is, and you really want to think about leaning away from it. And investors are not exercising due caution. So please think through, we've doubled the number of bonds, near as damn, in 10 years. We're at a record high corporate debt level to GDP in the US, and the spreads are very low. So invert that, the prices are very, very high. Record high debt to GDP with very low spreads is a really bad mix. And it's particularly a really bad mix for the guys and girls who are feasting on free capital. That's where the real pain will be felt. And bizarrely, that's where no due care is being exercised. But people are terrified of a whole other class of assets, which I will move on to. It's not all doom and gloom, because what I really want to impress upon you is where there is all this greed, this is coupled with immense fear, really tremendous fear, which is what we're seeking to own, seeking to buy and do own in spades. And those things fall into several categories, perhaps. One would be the disrupted. So everyone's terribly excited about the disruptor. Industries change, and investors just chuck the whole lot out. Baby, bathwater, the whole lot. What that leaves is opportunity. So this is one such opportunity. You've probably heard of it. Little company called BMW. It's a 100-year-old engineering firm of fine Bavarian ancestry. These guys got no surprise at all by the evolution of the electric vehicle. There is this crazy sense that Elon Musk somehow defined an industry by making EVs, electric vehicles, sexy. That is not at all what happened. The Europeans and the Chinese regulated fleet emissions 10 years ago and drove the industry towards this. EU 2020 is what is driving this change. Serious engineering firms worked on this problem diligently for years. These guys sell 140,000 electric vehicles a year. They're the fourth largest producer in the world. That's roughly about a third, if we're very generous, of Musk's sales. We make money on those. We also make money on our other 2.5 million vehicle sales as well, which is a nice thing to have, an actual profit, who would have thought? So there's no surprise here. These guys knew this was coming, and they're ready. They have the form factors ready. They have one manufacturing footprint that can produce all of their vehicles globally, only automaker in the world who can do that. They're growing their sales in China, which is amazing because that's probably hit peak car sales. And they've been brilliant in their management of this process, which shouldn't surprise people given the heritage of this firm. But I haven't got to the nice part, which is the price. So these guys will pay you a 5.5% dividend to hold it. That dividend is 3 times covered by earnings. We're on roughly the same price to book, so price to all the investment in the history of the firm less depreciation. We're on the same price to book as we were in 2009. Right? So coupled with that mania, with that greed, there is the fear in price to the same level as 2009. That's the kind of opportunity I want to get through to you. But that's not even the best bit about this thing. We're getting the automotive business for free. The value of the lease assets, receivables, and cash on the balance sheet of this business is worth more than the market capitalisation. So we're getting BMW's automotive business for free. That's the kind of thing that's exciting. It is the disruptor, not the disrupt. It's the disrupted, not the disruptor. It's not sexy or fun. It's old and dowdy. But this is where we need to look. We need to embrace the fear. The second category of stuff that's been chucked out, holus bolus, is emerging markets, loosely defined. I think maybe is the second biggest equity market and economy in the world. China might have emerged already, but it is nonetheless classed an emerging market. The kind of company you can buy there in the most ruthlessly capitalistic, competitive economy you can imagine, the class of stock you can buy there at the valuation you can get there is extraordinary. I mean, really extraordinary. So the example I'd give you is the kind of thing we own in our Asia fund and our international fund, so PMC and PAI, is Ping An. This thing, from memory, is 10 times the size of any of the insurers here. Sort of a $200 billion behemoth. It's grown its earnings compound at 20% for 20 years. It's one of the best companies in the history of companies. It's somewhat sophisticated. The image there is a thing, it's an app that they have. If you get into a bingle, you can get out of your car, walk around your car, taking a video of that car using Ping An's app, and in seconds, the money for the repair will go into your account. The approved workshop where you can take your car, instructions to get there will appear on your phone, and if the accident is sufficiently bad, it'll send a tow truck. No people, all AI. So this kind of thing, a true global behemoth, expert in fintech, history of exceptional growth, this thing we're buying for 10 times earnings. Right, so we get a 10% earnings yield. For every buck we put in, we get 10 cents of profit. That is extraordinary for the class of firm that this thing is. So we've had the disrupted, we've got emerging markets. Then the last thing is cyclicality. The kind of stuff that investors really hate at the moment is cyclicality. I want to rush off. I'm the average investor. I want to rush off and buy a thing that's never made a profit, but I don't want to own something whose profits go from, immense to not that big. That's what markets are doing. And this is a wonderful example. Again, you've probably heard of it. It's no undiscovered gem. But this is not a phone company. It's a semiconductor chip company, as well as being the leader in screen technology globally as well. Now, silicon chips are interesting, because this was a terrible business 15 years ago, with sort of 15 different competitors slugging it out and slashing each other's throats. There's now 3. This is a true oligopoly. This is an iron ore-like industry. At peak profitability, this firm is on 6 times earnings, with a third of its market cap in cash, net cash. So it's on 4 times its peak earnings in an oligopolistic business. That is, again, it is just simply extraordinary that we're getting that kind of opportunity. And look, if any of us are somewhat excited about data centers or AI or big data or any of that stuff, you are going to need some memory. You are going to need to buy these guys' chips in both DRAM and NAND. This is not some dull, growthless industry. This is an industry that will compound at something like 7% for the foreseeable future. So that's the kind of stuff we're getting. And that is truly exciting. But again, we cannot do that without enduring a little bit of discomfort, because they're all uncomfortable investments. The disrupted, emerging markets and cyclicals in this environment are uncomfortable. But they are often the things that are the most outstanding investments. Indeed, we have a bit of a rule of thumb. If we're all comfortable about an investment opportunity, we're probably wrong. We're probably missing something. And this is an absolutely crucial time for investors' wealth to lean into that discomfort. You're going to have to cop a little bit of discomfort to make money in this market. And conversely, if you run with the herd and want to go and buy your profit-free secular growers who will compound at some wonderful rate forever, and it feels nice, I really think you'll do yourself a lot of harm financially. So in conclusion, there is a genuine bubble, one of the great bubbles of all time, with awful investor behaviour accompanying it. I mean, I don't know if you guys have caught up on the sheer idiocy of the proposed initial public offer of WeWork, but that is the kind of idiocy that can only happen amid a bubble, a genuine surrender of rationality. This is where we're at. But very, very interestingly, that bubble is married to, is tied to, and is indeed being driven by fear. Investors are seeking to get away from anything, as Dermot mentioned, that's trade affected or cyclical, or has any of that apparent risk about it, and they're herding into things that are absent a cycle in their mind. To wit, I don't care what German industrial production is. I needn't care what retail sales are in China, as long as I can convince myself that Netflix will have more subscribers next quarter than this. That's the calculus that's being done. I can't guarantee you anything about the future, but what I can tell you with great assurance is when the world has looked like this in the past, the carnage caused by the bubble bursting is bad. So you need to lean away from that and endure a bit of discomfort to make money in this environment. Thanks very much.